Let's talk about coming up with and pitching ideas in the mutual fund industry. So you have to make sure that you know if your boss or future potential boss is a value investor like Warren Buffett, who used to like companies like Coke, or if your boss or future potential boss is a growth investor like Bill Miller. And Bill was a great growth investor for many years. He didn't care about valuation, right? And so he loved Amazon for years and years and years because he knew growth was very high today. And when growth slowed, profitability would improve materially. Okay. And if you're in the middle of that range, then that's called a GARP investor, or growth at a reasonable price. And the quintessential example of this is a brilliant man named Peter Lynch. And Peter Lynch managed what's called the Fidelity Magellan Fund for years in Boston, right? And he did very well. And so he doesn't really believe too much in growth or too much in value. He's in the middle, which means he's a GARP investor, growth at a reasonable price. GARP, growth at a reasonable price. And if you get a chance, read that book, please. It's called One Up on Wall Street, right? And Peter Lynch wrote this book years ago, and he talks about how he and his wife used to try products out before they would bother investing in the company. And one day he noticed that his wife, kept raging and saying how awesome this new product was. And it was this egg-shaped product, and you open it up, and there's pantyhose in it. And she bought it, I think, from a drugstore. And so what happened was Peter Lynch invested in that company and did incredibly well because of that, right? So use the product if you can. So on one end of the spectrum, you've got cheap stocks, right? And Warren Buffett is a value investor, okay? On the other end, you've got expensive stocks, right? And in between, again, is called GARP. So you got value on one side, GARP in the middle, growth on the right. Okay. And this is Mo, our mutual fund analyst, and he's basically telling us, he's right, you need to know exactly what kind of an investor your boss, the portfolio manager, or PM is, or you will pitch him the wrong types of stocks, which could be disastrous. The best mutual fund managers are the ones that invest in long-term themes and in companies that are called world beaters. And this was coined by a brilliant man that worked at Franklin Templeton here in the San Francisco Bay Area named Rob Dean. He was just a great investor when he was there, right? And so world beater means companies that are going to beat every other company in the world for decades, like Amazon. Amazon is a world beater. So if you work at a big mutual fund, try to come up with world beater ideas. All right. And as with hedge funds, we look at sector-specific stuff and company-specific stuff, right? And you really need to know when you work for a mutual fund, because you're long-term focused, you need to know where we are in the economic cycle, right? If we're just heading into a recession, don't buy a new, a company that's economically cyclical, like a housing company like Lennar. Wait until we're coming out of the recession, right? And these economic cycles can be 5 or 10 years. And so they do matter a lot to mutual funds. And sometimes you'll find that when it feels so incredibly uncomfortable to buy a stock, that's when you should do it. So understand if we're in a bull market, which means the stock market's going up a lot, or a bear market, which means the stock market's going down a lot because the economy's not doing well, okay? And understand if we're in the middle, things are fine. I'm picketing because things are fine. Anyway, I think you get the idea. So I always like to refer to Goldilocks and the Three Bears, right? And I didn't coin this, but a brilliant man I worked for years ago did in the hedge fund industry. He said that the best time to invest in stocks is not when the economy is doing incredibly well or the economy is doing poorly. It's right in the middle. It's kind of like Goldilocks and Three Bears. The middle is the mama bear, just right. So know where we are in the cycle. All right, so you focus, number one, on fundamentals. Then you focus on valuation. Then catalysts for entry purposes, right? Make sure that a company has a number of catalysts in the future. And why? Because other investors might get excited about those catalysts in the future and might buy the stock after you have. And I want you to be very, very long-term focused, obviously. And don't ever mention technicals to your portfolio manager in the mutual fund sector. All right. And so you see on this thesis here at the top, I wrote price target 1 year out. That was 2012, I guess. And then 2020, right? So the 1 year out, you kind of focus for hedge funds. And the one on the bottom there, the 2020 price target, would be more for mutual funds, longer term focused. And the template, you know how to fill it out, except for mutual funds, there's one massive difference, which is this. No technicals, okay? Just fill out the fundamentals section and valuation section. And this isn't the only research you're doing on a stock, right? You might have additional materials like your model and other stuff as well. But I love this one-page snapshot. In terms of fundamentals, ask yourself the 5-year test question. Is this company going to be more relevant or less relevant in 5 years? And are there barriers to entry, right? Can other companies come and compete in this market that you're analyzing? And also the management team. You really have to feel comfortable with the management team. Don't ever invest in a great idea with a crappy management team. Ever, please. Ideas are commodities, but execution is not. And read the 10K and the SEC filings thoroughly, and we'll cover that soon. Understand the risks. And you got to be really excited about a name too. Don't ever invest in a company unless you're really excited about it. Like, would you get your parents to own it as well? And how is your thesis different from other people's thesis on this stock? And would you be okay with the stock down 50% when you start buying it? You should be hopeful that it goes down a lot when you start buying it so you can buy a full position cheaper. And then you can also, come up with a SWOT analysis, which stands for what are the strengths, weaknesses, opportunities, and threats to this company. Look at the product life cycle and just do the Michael Porter 5 forces to understand what the driving forces are for this company. And we'll cover this in more detail soon. And then just understand if there is policy or regulation or political risk with this investment as well, right? If this company has material exposure to a country that is very left-wing, then just be careful. And then you also have to understand currency exposure, right? Does this company only sell in euros or only in dollars? And if so, do they hedge their currency as well, just in case, right? Just in case the currency goes against them. And check out also if there's gaps in the product portfolio, right? And sometimes you can kind of sense when a company might be doing an acquisition. Obviously, you never want to know. And if you do find out about something you shouldn't know, you tell your compliance officer right away, never trade the stock. But if there's a gap in the product portfolio, right? If it's so obvious that they need this product here, maybe they'll be buying a company or developing it in-house. Just try to think like the management team does, right? Think like a founder of a company does. And also understand, is anybody Uberizing this industry, kind of like what Uber did the taxi industry? And then look at behavioral finance things too, like insider buying or selling. And you can go to finance.yahoo.com and get all this information there. If management is buying, it's always a positive thing. I remember years ago, I was an investor in Activision, and the CEO, founder, brilliant man, funny guy actually, named Bobby Kotick, right? Every time he sold stocks, we would sell immediately and vice versa, right? And you could always back test these things as well to see if there's actually a trend there. And have you used their product yet? Please try it. Try before you buy. And talk to their competitors as well. It's very important from a due diligence perspective to talk to other competitors in the marketplace. And again, ask the competitors what their weakness is, meaning the company that you're doing research on. And then use that 8-step process, please. And one of the very last steps is obviously to speak with management because they're the best salespeople ever. And fill out your template as well after you've completed the 8-step process. All right. So far in the course, we've kind of covered fundamental stuff, the qualitative stuff, and we're really going to start focusing on valuation going forward, which you're going to love. So you're going to use Catalyst just for the entry point and not as a reason to sell, okay? Catalysts kind of help you deciding when to buy a stock. And if you're filling out this template and you kind of realize that, you don't like the idea anymore, then, stop working on it and just, complete it later or just look at another company. I want you to be a snob when it comes to investing. I only want you to invest in a company if the stars are all aligned, right? It's got to be perfect for you to put your money to work in it. And try to complete the entire one-pager template before pitching the idea to your boss, right? So because templates like this cover every question he or he can ask you about the company. And the same thing obviously goes for interviews. And my boss, this came years ago, this is something I felt, my boss hates when I change my opinion on an idea. So if something happens that makes you less bullish on the position that your portfolio manager, your boss owns, ask yourself, before approaching them, ask yourself this. If I knew of this new development, would I have bought the stock at all? And if the answer is a definitive no, then tell your boss to sell it. But make sure to show your new financial model estimates. Always do a qualitative and quantitative analysis. And your portfolio manager will always want to know if your numbers are above the street or below the street. And you can go to finance.yahoo.com and find out what the street is looking for numbers-wise on a stock and make sure your numbers are higher if you want to buy it. Don't worry, I will show you all this stuff later in the course. It'll all make perfect sense soon. And you also want to look at valuation of this company you're investing in versus the competition, which we will cover in the valuation section. And you have to understand if this company is going to be able to generate cash flow in the long run. And don't worry, we'll talk about discounted cash flow valuation in more detail later.